we call it the highest and best use of the land that you're on. And I say to all of my clients, okay, tell me about your house where you live. How old is it? Is it maximum size for the land? And 90% of people can add value in situ where they are. If you add 2 or 3 more bedrooms, if you add a floor to your house, what does that do? And they added some significant square meterage to the house that they're in. Millions of dollars added in situ, tax-free for the future. Most investors, when they first start out, don't know how to run the numbers either. Just do the numbers, understand what it means. And running a super fund too, especially in super, the cost of running the super on top of the cash flow and any of the other costs of running the property, often you can be negative cash flow pretty significantly inside the super, and you'll end up in a bit of strife pretty quickly.
Hey guys, welcome to this week's Money and Investing Show. This week we are diving headlong into property, some absolute rivers of gold in this interview. As always, make sure you take plenty of notes, but more importantly, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter. And this week, a change up in lineup. Very, very pleased to be bringing a fresh face and certainly some great wisdom to our show this week. And that's my dear friend, Mr. Jason Whitten. How are you, buddy?
Well, mate, thanks for having me on. It's been a while for us to get this organised.
It has. I was working that out when I was driving up here today. So we've been sort of knocking about in the same circles for about 18 years.
Yes.
And, dirt biking and all the different things as blokes we've done. And finally, we're here in the studio to talk turkey, I suppose.
Mate, the age-old shares versus property, or shares plus property, I think is a good idea.
I reckon so. It's such a tribal thing. People, I'm a property person, I could never do that. Or I'm a stock market person, I've got no interest in that. And they always sort of point out the dark side of both. And you and I both know if you want to be successful financially, they offer different types of attributes and they work together hand in glove. So I guess that's us here today. So CEO of Positive Group across a lot of different spaces in the property space these days.
Yeah, mate. Well, we've been doing this for 25 years now, sort of Australia and New Zealand. Helped over 10,000 people in Australia and New Zealand buy properties. We're sort of and counting. Along the way, we've learned one or two things, what to do and what not to do, that's for sure.
It isn't interesting. Everyone's so fearful of what not to do and mistakes, but that's, I think, where the biggest learnings in life often come.
Totally.
Sadly, they can be expensive too. So hopefully some of the wisdom that we're able to unearth today will maybe guide people away from the abyss on a few poor decisions.
Yeah.
Or if they've made them to realize it's okay, you're in good company, we've done it, and it's not a game changer, you just got to learn from it and regroup. That's
right, it's not the end of the world. Well, sometimes you got to get a return on those mistakes. I say to people, I've made plenty, so let me get the return for you on the cost of my investment.
What size t-shirt are you, buddy? I've got a few in the wardrobe, the mistake club, it's like, oh yeah, I balls that one up, but again, that's part of it. And I think sometimes psychologically, especially in the world of investment, because people have a huge emotional connection to their money, which I think can sometimes be a set of handcuffs with their decision making. And they put so much pressure on themselves that I've worked hard, I've managed to save some after-tax dollars, I can't screw this up. And that pressure of not wanting to make a mistake then causes inaction. Yeah. And you sit on the sideline and watch the game happen.
Yeah, I've seen inaction, but also then desperation at the end when you get a bit older and you do something you don't do enough, or then you end up doing something stupid, in those two camps.
Yep, you're chasing the game.
That's right.
And again, that's not ideal. So I guess, today's message is for anybody that's aged between 18 and 80, let's say, depending on where you're at in this journey, what we can do to help you. So look, let's talk a bit like property, like the stock market there's a vast array of differences in the assets. So when we talk property, in your mind, from an investor's point of view, or better yet, let's start with the primary place of residence. I mean, that's usually people's first kickoff. So what's the game plan there?
That's the first exposure to real estate for most people. And often the most exposure, we've got 17 or 18, million people in Australia with a mortgage. And, then that usually is related to their Prince Place of residence. Like, I'm a big fan of a Prince Place of residence because it's the only property most PAYG people will ever have tax-free. It's a tax-free vehicle. However, most of us don't approach it in that way. It's like, it's where we live. And, I know in your book, you've written some really good fundamentals about, it's the next 7-10 years of, where you're going to live. And, the place needs to be near schools and kids and whatever and those sorts of things. But also underlying that, it has a value. I always talk about, the game of tax in Australia. We want to sort of keep more than we give away to the government, keep as much as we make and or as much as we can from what we make. And your Prince Place of residence is a great place for that, for sure.
Yeah. People often go through the lens, oh, this is my forever home.
It's not. And listen, I can say that, 100%. I've sat down with thousands of people across the table and said, well, why did you buy that property in the first place? And they say, well, it's what we could afford. And nothing wrong with that. Everyone starts there. You sort of get what you can afford, and hopefully it's in those places for schools and whatever. But don't be afraid to upgrade that over time. You and I talk about bad debt reduction. Good debt is something that brings in income and growth and value and other bits and pieces. And bad debt is something that just sort of, costs you money and doesn't get you anywhere. If you can eliminate bad debt off of your principal place of residence as fast as possible, I know we've taught that many a times in our circles when we've been traveling with Anthony Robbins and others. Get rid of that bad debt quickly. And then, if you have the possibility as your life goes on with your income going up, upgrade the value of a principal place of residence. Because if at some point in the future you ever choose to downsize or right size or sell it, no tax, capital gains tax free. It's one of the only assets you got.
Yeah, the idea of upsizing, I know we've both been prolific breeders in our time. We have kids between us, that's for sure. And
that's
the need for more space and the lifestyle that goes with that is a determinant there. And it's crucial that you get on that ladder. And I think so many people just delay because they can't afford what they want. And I think sometimes just getting in and getting started is just that crucial thing. What would you say to someone that's sort of second guessing? Should I, shouldn't I? What about interest rates? I mean, there are always going to be factors. What would you say to get them moving?
Listen, at the end of the day, if you don't jump in now, it's only going to cost you. The longer you wait, it costs you. There's a few things that it costs you. Number one, the opportunity cost. Markets go up and down, share market, property markets, they do. I've never seen someone go, oh, I'm glad I waited 5 years because I got it at a better price. I haven't seen it.
Yep.
And I think that's kind of a furphy, it's this thing, I'll wait till prices get better. I'll wait till something gets better. 99% of the time, your owner occupier property, especially good locations. If a good suburb is attractive and it goes up in value, good times are bad, closer to the schools, transport, land sizes, all those sorts of things. It doesn't really get that affected in comparison to suburbs that have got less appeal. So I would say to people, if you wait 2, 3, 5 years, it's going to be, tens, if not hundreds of thousands opportunity cost into the future,
It's a big one, isn't it? And nothing's ever perfect. I think you always regret more the things you don't do than the things that you do.
Yeah.
Maybe come back and talk a bit about some of the economics and the direction we see markets with interest rates and occupancy and supply a little bit later on. But I guess we always say to people, particularly as they consume the podcast, is don't take notes, take action. You've got to. It's not a spectator sport. Life goes by in a heartbeat. It's taken us 15 years to sit in this room. There's a good few war stories between then and now too, I'm sure. But time goes by so quickly. You've just got to get that money working for you. And that notion of upgrading a family home isn't necessarily a snob value or a lifestyle inflation. That can become functionality or the ability, as you say, tax-free to get a bigger chunk of money working harder for you.
And it doesn't have to be selling and moving either. There's a lot of value in buying a place at some point in the future. You could, we call it the highest and best use of the land that you're on. And I say to all of my clients, okay, tell me about your house where you live. How old is it? And is it maximum size for the land? And 90% of people can add value in situ where they are. If you add 2 or 3 more bedrooms, if you add a floor to your house, what does that do? And you and I have got a few friends, and one of them I coached in this just recently, and they added some significant square meterage to the house that they're in. Millions of dollars added in situ, tax-free for the future. And that sort of stuff, maybe you don't do it now. Maybe it's a 7-10 year plan for that upgrade, but it should form part of the thought process as you go along. Everyone's got to have somewhere to live. If you're paying rent, 9 times out of 10, it's you're making someone else wealthy, so you might as well pay your own mortgage and have something for the future.
I love that philosophy, and I think I've always bought with the view of value adding.
Yes,
and I guess it's the trader in me. You make your money when you buy, not when you sell. And if you I'll go back to my first place in London, which was, I look at it now and I think it was a health hazard. It was a decrepit Victorian, tiny little house in a not desirable suburb. But what I was able to do with that and then parlay that into the next thing. And I think viewing that notion that here's an asset, you don't necessarily have to move. If you need more space, you can add more to it. In some instances, a little harder to do that in London. But what can I do to value add? Is it landscaping? Is it extra occupancy space? One thing you can never do is change the location of it, which I guess brings us to, how do you go about picking location?
Yeah, well, certainly a principal place of residence. I like, what you said in your book, and it dovetails into our world. Make where you want to live, if you can, for your budget and your price point, a really attractive place, not only for you, but for others in the future. Owner-occupiers drive markets in unreasonable ways. You know what, markets that can be so volatile, and you go, what? That doesn't make any sense. Why should people are paying that much? Well, someone wants to live there in a school zone, close to work, those sorts of things. Those are the ideas that you want to have. And if you can add value into the future, or choose a place that you can upgrade into the future, or somewhere it's limited or, under, in demand for those reasons, there's always going to be, defying the market. And residential real estate, especially owner-occupier residential real estate, makes no sense, right? It makes no sense.
I guess it's an emotional purchase.
It is an emotional purchase.
It's not down to yield. It's not down to the hard numbers. No. It's that. I was just in Sydney at the weekend, and my best mate's down there. He's in Bronte. They're always going to be in Bronte because that's their scene. Yeah. Now the kids are ensconced in school. Yeah. It sits well with their social life. Yeah. And he's recently upgraded, and it's a crazy decision financially. And he's in the hedge fund space. So he's a nuts and bolts person. Yeah. And he's like, I don't care. It's making us happy, and we want to be there. So it is an illogical market insofar as that emotive pull for your primary place of residence is great. So let's shift gears. So let's try and leave emotion out of it and get onto the nuts and bolts of investment property now, which is your forte. Tell us a bit more about that space.
Well, I mean, one of the things that I like to say when I'm sort of chatting to people about investment property is that I'm a specialist in residential investment property. And investing for me is buying something really well and owning it for 15 to 20 years. So what I talk about, whatever I'm going to talk about today and with any of my clients, investing is about owning for quite a long time. Property is slow. Real estate is slow. It's not like the stock market. It doesn't, you don't want to be buying and selling real estate. The in and out costs are ludicrous.
That's an interesting one. Can we pause there a second? Yeah. So on there, Jason, like your time frame, as a professional that's made, and we don't need to go into the personals, but substantial money in this area, is not trying to necessarily time the market perfectly and just have this window to say, look, this is an asset I'm going to hold for X period of time, and I'm going to just let time do its thing. If I buy well, which means at the right price, and just sit back then and let it work, that's in very, very broad strokes more effective than trying to trade real estate.
It has been for me. And also, you've got to think about this in terms of, I do for most of my clients, they don't want another thing that's going to be stressful for them. So residential property investing, if you own sort of 3 to 5 investment properties over a 15 to 20 year period, and they by and large take care of themselves, you've got a good property manager and you've got a good team around you, it should be low key. It shouldn't be you have to do anything to it. It should be running, I don't say passively, but, not so active. And that's the idea. That's what I like. Now, I do run active investment strategies with real estate because I'm good at that stuff. I property develop. But the majority of my wealth is in just really boring, good quality pieces of real estate that I've owned for a long time.
Meat and potatoes.
That's meat and potatoes, exactly. Yeah. And I was saying this the other day to, a few of my clients, properties that I've owned for 15 years, in the last 3 years, if you include sort of the COVID years, in 4 years it's gone up as much as it went up the previous 15. And I'm like, it's just, that's going to happen. You have no, you can't see the future, but that only you've got to be in the game.
Exactly right. You have to be. There's no point being on the sideline going, you're lucky you timed that well. Well, not really. It was a 15-year overnight success. I was ready for it and it happened.
That's right.
But if you're not in the game and you're on the sidelines, it doesn't happen. So there's a couple of things to unpack in there. And I mean, I know from my own experience with rental property, there is a level of work there, but it's nowhere near as daunting as what people would think.
No.
Making sure your record keeping is solid, your landlord insurance, you got a good letting agent, you do your landlord inspections, and you keep an eye on your numbers in terms of can you get a better rate on your mortgage or your landlord insurance. And then you're starting to then look for things to do for the sake of it. They're the big sort of pillars. Would there be anything else that you'd add into that?
Well, yeah, I like what you said there, because I tell people, buy your investment properties and then go get a hobby and leave them alone. All right,
stop meddling. Let it do its thing.
Let it run. But so we call it the 6-star team. If you've got the right team around you, then those professionals will guide you. Never abdicate responsibility, right? If something's happening with your investments, if you don't know what's going on, then, more fool you if you get duped on it, right?
Yeah.
And real estate's fairly well straightforward at the end of the day. Good property manager. They're going to spend more time at your property than you ever will. So choose one, right? You'll never visit, unless you live around the corner from it, you won't visit the property, but your property manager will visit maybe 3 to 4 times a year, take 1,000 photos every time they go, because that's what they should be doing, giving you a report, making sure that the maintenance is done.
How do you go about finding a 6-star? Because I've had a really mixed bag of, particularly, as you say, if you're around the corner, you can do a drive-by, and, if the tenant's not mowed the lawn and there's 4 car wrecks sitting in the driveway, it's probably not going to be much better inside. But when it's interstate, I guess it becomes a little bit more challenging. I've always tried to do a property inspection with the letting agent if I've been able to kind of tee that up. But how do you go about finding what you consider to be, a decent
one?
They will talk a great game.
They do. Listen, technology makes it a lot easier these days. But I can tell you my rules interstate is I don't want my property manager being attached to a sales agency. Okay. And I'll tell you why. The property management businesses in most Australian residential real estate agencies are attached to a selling agency as well.
Okay.
And the selling agency uses property management as a prospecting place for they invest very little in their property managers. They underpay them, overwork them. And the property management as a default becomes low quality. Then the owners of those properties, I want to sell, I've had enough of this. And
going across you.
And listen, that's casting aspersions, but after 10,000 investors across my desk, it's very rare, and maybe a handful of times, 5 times in 10,000, that someone said, yes, the sales agent said, don't sell, you should just get your property manager to fix your property up. And this is what I see. So people get 5, 6, 7 years in, and whatever happens in that relationship, they end up selling the property too early, and not,
which I've done myself on that basis.
Yeah. So for me, finding a property manager that is not attached to a sales agency. I say, are you part of a sales agency? No, great, because all they do, manage your property.
And do a good job.
No agenda, right?
That's interesting. Yeah. So let's circle back for a minute. So no one wants to get a bloody nose. No one wants to make a mistake, and you've just pointed out something that, I'm not supposed to be a professional investor, that I've fallen foul of myself. I had a property in Melbourne, which, again, if I'd have kept it, would have done very, very well over this most recent period of time. And I didn't for exactly that scenario. So I'm now in my head, I'm listening to you, how did I miss that? And this is the value of education and talking to people that are experts in their field. And I love that notion of a standalone property agent, because I guess you eat what you kill. If you're good at what you do, there you have a great business. That's rather than just being the sort of suckling on the other side of it, which is really, really interesting. And that's a huge, huge tip.
Yeah. And, you can ask those property managers how many properties they manage. If they're managing 200, 250, 300, well, the quality of them spending time on your property is probably going to be reduced. Some of the technology that they use, there's some great apps and some great inspection technology now where they can take, our guys use an app that takes like 1,000 photos, and then it does, that's all there accessible for you, timestamps it, all of those sorts of things.
Nice.
So yeah, a few of those things are pretty important, but the big one is, how do they make their money? And if it's only about managing your property, then they're going to do the best job possible, because that's how they get rewarded. Otherwise, I think the agenda's a bit muddied in my woods, in my neck of the woods, in that opinion.
I like that. I mean, that's really practical. Should have been on the podcast a bit earlier. I wouldn't have sold that property. Thanks, buddy. Lunch is on you. Thanks for the advice. Okay, so that's a really good mistake. What are some of the other typical mistakes? Maybe probably one, because I guess it becomes a fork in the road. If you've made the decision, and I love action takers. Yeah. They've made a decision. They've obviously worked. They've managed to save some after-tax dollars. They've committed to, whether it be the stock market, whether it be property or both. They've made that decision, and that first feedback that you get from that decision, I guess if it's not so good, could stop that journey there and then at one, we tried, it didn't work for us.
Yeah.
Like somebody bought a Duff share, the stock market's no good. And it's not that the process was wrong. So what are some of the key mistakes that you see people make, particularly say with property one or property two thereafter?
Certainly property one, I see two mistakes that most uneducated or unsupported investors make. Number one, the way they set their finance up is they cross-securitize or cross-collateralize with their own home. Big mistake.
Yep.
And it probably doesn't show up in property one. Like it's probably, that was easy. But it shows up in property two or property three or property four, or if something goes wrong. So the wrong finance is a death knock waiting to happen. And
so that again is really interesting. So I've seen a couple of people personally fall foul of that. So one of the latter properties, you're sucking the equity out of each of those deals to get to the next one. They're all bundled in the same way. One falls over and the dominoes all tip over, and you're out of your primary place of residence as a result of it, or in big debt.
Yeah, and you can there are ways to do that properly, and you can take a portion of the equity from your principal place of residence. You're still using it, but it's not cross-securitized or cross-collateralized. And when you talk to the right broker who understands this loan is not the only loan they're doing. They're structuring you for the second and third and fourth loan because that's your investment plan. It's a whole different kettle of fish,
So plan. There's a plan in there. It's not just, let's just wing this and we've got, the market's been strong. No question about that. We've got a couple $100,000 of equity we can take out of this. So you actually take it out, put it into a separate bucket, and the collateral that sits behind it is just the cash, not the title on the.
That's correct. Yep, splits and certain loans. So that's structuring that well is smart, and especially certainly for business owners and people who take risk as well. The biggest issues is they use, let's say, an overdraft or something with their business. And the bank's like, no problem, we got you. And it's secured against their home, and something goes wrong with the business, then everything's gone. So, disaster number one, get your finance sorted, understand the impact of what you're doing. And sometimes it does cost a little bit more, but I can tell you, let's say a few $100s extra for the year. If something went wrong, you'd pay tenfold that to stop it going wrong.
Too true.
Yeah. And then
price and value are really different. Price what you pay, value is not necessarily what you get.
Yeah, that is true. Well, at the end of the day, once you've got your finance organized, you understand that, then the property is pretty important. It's so important to have a good experience on the first property. And, in my world, a good quality property that's going to grow in value, because most people, know that if they want to build a portfolio, it's usually the first shot of that property is like, okay, I've released $200,000 of equity from my home. I'm going to put 120 into this first investment property. I'm going to keep some aside, which is a buffer or, something just in case something, maintenance or whatever. I want that to be returned. The return of that deposit in a timely manner that you can recycle it and continue to go is kind of the key piece of that first property. And a lot of investors who haven't done the work to sort of build out their plan think, I'll just do a cheap one. I'll do it. This will just be a test or something like that. And you got to buy something decent quality to begin with, and sometimes that might be $100,000 more than you're thinking. A good quality property, you'll have a much better experience, and the tenants that you attract. At the end of the day, a good agent doesn't want to work on a piece of rubbish property either. They're like, that property's only going to give me grief. Where a good quality property. So I say, in the early days or the first investment, maximize your buying power. There's no value in if you can borrow and buy at $650, you buy $450. There's no value in that, because the quality of the property between $450 and $650 is vastly different. Location, quality, style, whatever it might be.
Well, it's interesting. I mean, again, it comes down, I guess, to an extent location, and you can have, and again, if I take my own experience, I had one in Melbourne, which was in Toorak, which was a cracking location. Can't fail for it to work. And had at the time a couple of people knocking the door going, but this is brand new and it's got a pool. And you go, it's a rental property. I don't want something that's going to have huge body corporate fees for facilities I'm never going to use because I'm the landlord. Instead, I've got a 2-story walk up that's just meat and potatoes again, but is in such a great area. I'm going to get a young professional tenant that's likely to be able to pay their rent. It's down the road from the tram. It's got those things sort of ticking along for it, and a very, very unglamorous, albeit great suburb, but albeit an unglamorous property. So definitely that's maybe I've just netted out my previous mistake by at least getting good location there, and then you can parlay off that, I presume, as that one then starts to increase in value, and then you can go from there. So what's the next step from?
You do, like, as your properties start to grow, you can recycle that equity. You know, I like the idea of over time, those properties being able to fund the purchase of the next one. So the first 1 to 3 properties, your investments are really kind of key. So once you've cracked the back of those 3, they become then a self-fulfilling prophecy. Every time you've got the ability to borrow and you've got enough equity, you purchase another one. So, you know, that's where and sometimes that can take 5, 7, 8 years to get going. But, you know, and like you said before, we don't wait 3 years and then start and then take another 8 years, you know. 11 years has gone by and then you're only just getting cracking, like get going now. So, you know, really that's a few mistakes that happen in the early days, especially in and around lending. You know, most people don't understand why or when it's a good idea to use lender's mortgage insurance and borrow at, let's say, 88% instead of 80%, interest only versus principal and interest. For me, interest only for the first 5 years. This is about getting the property out ahead of itself, getting some growth. You can set up a loan, make a principal and interest payment. You can pay the interest and put the principal in the offset account if you want to, but don't give it to the bank. And so, you know, especially when every dollar counts. You know, if you give a principal payment to the bank, you've got to beg to get it back. And, you know, they're not great people to ask for money. You know?
I guess if you're wanting that money back, it's because there's been a bit of a change in circumstance. They've typically signed up on their lending criteria then too. That's gold in itself. So rather than pay the principal, whack it in an offset, and then you've got access to it and tax efficient to do that too.
That's right. Yeah. And I call this controlling the cash, right? So especially in the first 10 years, every cent counts, you know, and if you have a tough moment, you need that money, you know, when you're in trouble, you ask the bank for money, they're not going to give it to you. What they say, like, you know, the bankers are, you know, fair weather friends. They give you an umbrella when the sun's out and they want it back when it's raining.
Yeah.
Right.
I love that.
You know,
that's very true. It's that's gold. That's pure gold. In terms of some of the other mistakes that we see out there, we've had a bit of rehab to do where we've had clients that have come through to us that they've maybe been into a property event. And look, there are a lot of property events out there. And some of them, let's just say, are better than others. And they've, at bare bones of their backside, set up an SMSF themselves or as cheaply as possible with the sole purpose of buying a property that was spruiked at the event. And it's just the beginning of the problem. What are some of the things that can happen under those circumstances?
Well, listen, you know, a lot of those properties have costs that people don't understand. You know, most investors, when they first start out, you know, don't know how to run the numbers either. You know, we've got some great free cash flow calculators we give away. We'll give a link to you and your crew if you want to give them away. Just do the numbers, understand what it means. And running a super fund too, you know, especially in super, you know, the cost of running the super on top of the cash flow and any of the other costs of running the property, often you can be negative cash flow pretty significantly inside the super, and you'll end up in, you know, a bit of strife pretty quickly.
That's one that I've seen happen a lot where, there's a subdivision that's opened up, and obviously the company that's spruiking the property is getting, I'd imagine, a fairly handsome kickback from the developer to sell the block of dirt as a house and land. And all the rentals projected to be this because this is what's in the area, but that's on the assumption that there aren't 500 new houses going in there that are all going to be up for rent because they've all been sold to people in your position. The rent's less than what you're expecting, and now you're in a position where you're geared up to Billio in your super. And again, this, I guess, comes back to one of the comments you made previously, that this I see typically happen to people that have left their run late and they're so desperate to kind of right the ship that those blinkers were on. And in good faith, they've had a crack at what probably doubling every 7 years. We're going to be fine. It'll help us. But they've just done it in a way that hasn't been helped by some unscrupulous marketing.
No, and certainly, you know, another tip in that, you know, if someone says, all right, the rent's going to be $700 a week, get a second and third rental appraisal, because I can tell you right now, it won't be 700. It'll probably be 550. As of today, I've seen it 1,000 times.
Yep.
And, maybe the market's growing. Like right now, the last couple of years have been fantastic for rental growth. But someone sitting here right now who's got there is zero licensing or obligation for that quote to be accurate in the future. Zero.
Terrifying.
Yeah. And so you go, I better check that, So
again, great advice. Measure twice, cut once. I guess in that space.
Yeah.
So if you were to look at two models, one being the attributes of an investment property, and we won't give away your secret sauce in this, but what are some of the attributes, say top 3 attributes for something that's more likely to be on a yes side of the column? And then what are 3 attributes of a property that's likely to be on the no side of the column?
So for me, when we say, okay, make this thing as simple and as low-key as possible, I like newer because, there is warranties, guarantees. The lower the cost of holding and maintenance, the better off you're going to be. Now, just imagine this. If you bought a 20 or 30-year-old property now and you want it to sustain you for some income or some wealth in the future in, let's say, 15 or 20 years' time. Let's just use 20 years because it's a round number. You buy a property that's 20, you add another 20, that property's 40 years old.
Yep.
It's been worn hard. Yeah, it's worn hard, right? So, in my world, newer, sort of under 10 years old. So that's my preference in that sort of sense. Check your cash flow. You want it positively geared. Now, some people like gearing, which they have an income and they're going to offset some of the property's costs and have positively geared after tax. Nothing wrong with that. Make sure it's not too negative pre-tax.
Yep.
PAYG variation. Anyone who is an employee can vary their tax that they pay weekly, fortnightly, and monthly. Now, a lot of people go, well, the property's $5,000 negative cash flow. Well, if you do a variation, it'll be $2,000 positive cash flow in your pocket because you're claiming the tax back as you go.
Yeah, that's the big thing, isn't it? It's not a June 30 job. It's on that weekly or monthly as you see it through.
That's right. And I just say to people, put this in the calculator. Put $200 a week or $100 a week in the calculator. There's a basic Adelaide bank calculator you can go and do. $100 a week extra payment on your mortgage. Just do that. If you claim it back weekly and you made a payment, but you wouldn't, you'd put it in your offset account, right? But if you did that, that'll save you on a $650,000 mortgage, $300,000 in interest over a 30-year period.
So for anyone justifying the amount of time they're investing in consuming this podcast right now, so now we're 25, 30 minutes in, there's a $300,000 saving right off the bat. By not doing what everyone does. I'll get the mortgage paid off. I remember my parents' advice, and I'm sure yours being in a similar generation, get your mortgage paid off, son. You'll never be free unless you don't. And look, I hate debt, as you know, so I don't have debt. But in that instance, $300,000 just by understanding the process. So it's cash flow positive.
That's right.
Getting it off, but not paid to the bank, put in your offset. Put it into the benefit, but they haven't got the dough.
That's
You've got
right.
Control of the cash.
Yeah, control the cash. Yep. I'm the one. Yeah, and what we do see is a lot of investors or potential investors, they're kind of stuck because how they treat their money and where it flows and who's got control of it is out of their control. And so sometimes it takes 6 months, a year, 2 years to unlock all of that kind of, the fingers of kind of everyone else has got their fingers in your pie. Get their dirty, grubby fingers out of it and start controlling it yourself.
Well, it's your dough. You've got to look after it.
That's right.
So that's all stuff on the green light side of the column, the good stuff. So hopefully there's plenty for our consumers, our listeners to take out of that. What are some of the red flags? What's on the no-go?
So some of the no-go stuff for me is places that, like I said, a lot older, physically a lot older, unless you're willing to put money into them. And some people don't have enough money to upgrade them or update them on the way in.
And I suppose if it needs a renovation, it's also going to be untenanted for that duration as well, which you're still going to be paying the mortgage off on it, but there's no rent coming in.
That's right. And you've got to have enough cash. And listen, that's quite a good strategy if you know what you're doing. But for most people, I don't recommend a renovation in any way, shape or form. That's anything past, minor carpet and paint and, maybe a few updates to the light switches or something. So, red flags for me, where properties are located and they are disconnected and isolated from infrastructure. You talked about the tram before, right? A a property that might be cheap, but there's only one road in and out of that suburb, and you have to drive, 10, 20, 30 minutes to connect to somewhere else. Now, unless that's a lifestyle piece of real estate, then it's isolated. It's isolated from infrastructure. It's isolated from future investment from governments. It's isolated from anything that will drive that other than it's a cheap place to live.
Yep.
And when you compete at the cheap place to live,
what kind of tenant you like?
What kind of tenant you got? And so and here's the other thing. The moment that person gets money in that cheap place to live, what are they doing? Are they staying there and upgrading their house? No, they're moving. They move. People with money move from those places to places that they've always desired to be, right? It's called aspirational suburbs. And that's one of the little tips for us. A lot of those fringe suburbs we call aspirational are the ones where the new money will come and they will pay more than they should to move
to get in there. We're now living in Woollahra, whatever it might be.
That's right. And we've all experienced them over 10, 20, 30 years looking around. You go, I would never have lived there back in the day because it wasn't the place, but it became aspirational because of a few things, you know? Yeah.
That's really interesting too. And that connectivity, and I guess, I've always sort of thought, and I guess, a lot of things changed in the post-pandemic world where, that proximity to work is maybe less of a draw than it was. We've gone from a fried egg model of town planning to scrambled eggs where you can be anywhere and do what you need to do. But that seems to be shifting again now where people are going back into the office or the workplace. So that proximity to be able to get into town and be connected is huge. And I guess, suburbs, if you throw a pebble in a pond, the last suburb, the ripple goes right the way out to the edge of the pond, which gets there eventually, but it's probably the first to decline when things get tough as well.
That is true. So what happens is, that, it comes out, but it also retracts. That value devalues until it compresses, and so supply, places that have hyper supply, don't expect. So and this is a balancing act. You might get something high quality piece of real estate in a hyper supply area. There might be a greenfields place. You might be able to get a house for $650, but it's going to stay $650 for the next 6, 7, 8 years because that whole area has to fill in the supply. Now that's perfectly fine as long as you've got a 20-year view of what you're up to.
Right.
And let's say places like Springfield, is a classic example west of Brisbane. Fantastic. It stayed sort of stable pricing for close to 10 years and literally in 5 years doubled in value because it was full. It had hospitals and train lines and universities and shopping centres and all the infrastructure went in, and then it filled in all of the master plan, and then the pressure came. So you just got to understand sort of the different reasons you might go to a place like that. You might say, I'm going to get in early. It might incrementally grow, but then once it's full, then that's when the prices do bump, and the rents go quite nicely actually in those places because people like newer properties to rent. And they'll pay a premium,
clean, tidy, new kitchen. And I suppose from a landlord's perspective, if it's new, depreciation schedules make it far more tax effective for you, and builder's warranty. Well, I think high rises, is it 4 stories for builder's warranty? I suppose it depends on the state, doesn't it?
Depends on the state, but you get warranties on the building, you get warranties on all of your, white goods and those sorts of things. Depreciation is fantastic, especially if, you might be a bit of a higher income earner and the property for you is a place for future wealth, not immediate cash flow. So you might neutral cash flow it and positive after tax, or even slightly negative before tax and then positive after tax. Great for tax deductions. And those sorts of things as you go along. One of my strategies of recent times, especially in the last 4 years, is furnishing my properties. Now, this is where the age-old apartments, townhouses, or houses. Well, I've got a really good mixture of both, and my apartments in good locations furnished 2 to 1, double my income on my apartments. The growth is slower, it always is, but not significantly, not half a house or whatever. But my houses, I can't go furnish those and triple the rent where I can furnish my apartment, and almost some of them I've got triple what I would get unfurnished.
Wow.
So this is the balancing act of what's the investment for into the future? What type of flexibility do you want? Not only value flexibility to to increase, but also income flexibility.
Isn't it interesting? You know, if I need to get some property, I need to make some money.
Yeah.
You know, and making money might be the goal, but there are so many different pathways, and there's so many different types of money to make. Whether it be income and cash flow, whether it's capital growth down the line, whether it's tax strategy within there. So it's not just I've got to get a property.
No,
more to it.
Yeah.
It pays to have a team of people that can help ask you the questions.
That's
to get you thinking, rather than a one size fits all.
And listen, you know, you and I chatted about this ad nauseum. You know, residential real estate isn't a great cash flow vehicle. It's not like I'm going to make $100,000 in cash flow out of 3 properties, or certainly regular residential Australian real estate. It's a great place for capital growth, medium to long term. It's a great place for tax minimisation. That's a short term benefit. It's not a reason to invest. It's go and lose money to get a tax deduction is a thing called dumb. Yeah. But by default, you can get some. But trading shares, running a business, your career, they're much better places to generate cash flow because they're set up for that. If you know what you're up to, residential real estate might generate some positive cash flow, but unless you're sort of going to Timbuktu, which I don't like because it's so volatile, that mining towns or those places. My preference is to use your property as a medium to long-term capital growth vehicle with some tax deductible purposes, and then use your career or your business or some other things that are more geared towards cash flow if you want to, have a higher cash flow activity,
It's interesting, isn't it? You've got to get in, you can rent this place out for $1,400 a week. And I saw that, with the mining boom, over a decade ago. And then when the backside dropped out of that, valuations are a fraction of what they were. And it's definitely negatively geared at that stage.
And negative equity probably for a long time. We had one.
We had a client that had a couple of fibros up there, $1.5 million each for them. They're renting at $4,000 a week when the times were good, and all of a sudden you can't rent them at $450 a week, and the value is now $400,000.
That's right, and they won't rent for those numbers to anyone who lives there locally, and so that's the problem with those things. And you've got to be really cognizant of, when the construction crew's gone out of town, who's going to rent this damn thing and what will they pay? And the local person who might be a cocky on one of the stations, or working at the local servo, on minimum wage, they ain't paying $4,000 a week for a crappy old house that's 30 years old, is about to fall down.
No, not going to happen.
Yeah.
Interesting. Let's get into some economics to put a bit of ribbon around this. So, I mean, where do you see the market? What are the 2 or 3 major factors facing Australian real estate as we speak?
Well, the big headwind right now, unless you've been living under a rock, is interest rates, and everyone's sort of nervous about. Well, property owners are nervous about them. Certainly, owner occupiers are feeling the pinch.
Yep.
Cost of living, cost of interest. Highest it's been for well over a decade. That's the big headwind right now. On the flip side, there's nothing else holding it back right now, and this is it's a terrible thing for those who aren't in the market. Right now, we've got the worst undersupply Australia's ever seen in residential construction. A number of factors are leading to that, but it started actually with the APRA investigation and the rearrangement of lending, in 2016-17. However, our ability to deliver and construct real estate has significantly declined, consistently.
Why are we seeing so many builders fall over on that? If there's a huge demand for the product, is it simply just the cost of construction and labour has gone through the roof?
Yeah, those are 2 factors that haven't helped, that's for sure. There was and this is where, I did a heap of podcasts, and if you want to go back and find it, trawl through the stuff that we did in 2020. And I said, the government's giving away money like drunken sailors. It spiked the number of land sales and the number of off-the-plan sales in Australia, highest we'd ever seen. And I said, we've got a problem here. We've never built this many properties ever in Australia's history, and we've got some supply chain issues coming. This is a disaster waiting to happen. And it came home to roost. More than 50% of the houses that were contracted couldn't be built for that price in 2020. So come 21 and 22, and even in 23, 3 years later, those properties that were sold had not been delivered. and many of them had to be repriced, sometimes even $70, $80, $100,000 more. And guess what happened at the same time? Interest rates went up.
Right.
Fell over, builders couldn't last that long, supply chains that couldn't deliver. And we've seen the largest amount, 2,500 plus liquidations and bankruptcies in the building industry. The largest in Australia's history by percentage and number. It's a damn disaster. And the government's got their heads firmly where the sun doesn't shine, not even paying any attention. And then talking about building 1 million houses, how are they going to build them?
Yep.
They've never built that many houses ever in Australia's history. Never in Australia's history have we ever built that many. And they're saying now with the most amount of bankruptcies in Australia's history in construction, we're going to build a record number of houses. What's going on, right?
We're from the government. We're here to hold that terrifying. That's terrifying expression. That is really scary when you look at it. And I think also, the building industry is also the single largest creditor to the ATO as well. So tax receipts are dropping on the back of that too, and the debacle that sits in there. So we've got acute supply shortages right now. We could kick the can around as to where interest rates are going, but we're both trying to read the tea leaves and doing that. It doesn't matter what they do. If you're a landlord, you can pass it on. If it's your primary place of residence, you're going to have to suck it up, maybe get a side hustle to earn some more money to chip away at it and get you through those times.
That's right.
So we've got interest rates that are there. We've got a strong demand for property, which would suggest that the upward pressure is unlikely to shift anytime soon.
No, it won't go away. And because there's no supply of fresh stock, we've seen 40% reduction in long-term trends on second-hand properties being sold as well. So no new property, very low new, and some of the states have dropped 70 to 80%. So we're delivering 70,000 properties, and now we're only delivering 15,000, and that's approvals, not starts. So it's going to get worse in 20.
So it just gets thinner as you go further along.
It gets thinner, right? And so then the prices are out of reach because the interest rates went up. So, the regular person trying to buy a property now used to be able to afford 700. Now they can afford 500. There's nothing for sale for 500. They can't. And even if it is, it's nowhere they want to live. So we've got a challenge there. We've just had record highest immigration or immigration into Australia, students plus permanent migration. So you see these things are no supply, no one reselling their properties, and we've got, depending on which numbers you look at, anywhere from 600 to 700,000 new people come in the last 12 months. Where are they going to live?
Good news if you're a landlord. Don't forget though, the government gave, was it $19 a fortnight? Straight at the landlord's pocket. That's going to really make a difference. I'm sure. It's an interesting conundrum. Jason, thanks very much for your time. I think we might continue over a beer and a bite to eat in a few moments because it might not be broadcastable, but it's certainly interesting when you look at where we are within the economy. And I think people can look at things through two lenses. Oh, that's a problem, or there's an opportunity in that. And I guess our goal in the advisory space, is in the coaching space and mentoring space, is to provide the opportunity lens to people so that they can be part of the upside of that rather than be beaten over the head with the downside.
There's opportunity right now. And for those who understand the opportunity, those who don't are sort of standing back a little because they want interest rates to go down. I don't think that's going to happen for 12, 18 months. In the meantime, the opportunity, if you know what you're doing, is there, and you're going to get well rewarded when things go your way.
Okay. So what I'd suggest for our listeners, if you want some more information, want to better reach out and have a chat with Jason, easiest way to do that, hit us up at property@australianinvestmenteducation.com.au. We'll flick you through to our team of experts. And I think sitting here, and I've done my fair share of property, nothing like the magnitude that you've done, because I'm on the dark side, I'm on the stock market side, right? And I can see mistakes that I've made. For example, the letting agent is just pure, the property manager, pure gold. And I can see good things that I've done too. And I think on balance, if you can get that right first time, you're in a great space. So first up, buddy, I know it took us 15 years to make this happen. Thank you very much for sharing your time with us.
Great to be here, mate.
Again, for anyone listening, hit us up at property@australianinvestmenteducation.com.au. And I hope you enjoyed the show. Make sure you give us some comments and feedback below, and we'll look forward to chatting with you soon. Cheers.